Investors watching your money this week. Joining me now, Michael Lee, strategy founder, AmeriVet Securities head of U.S. rates, Gregory Faranello, and CMC Markets chief market analyst, Michael Hewson. Michael Lee, let's go ahead and start with you and talk about stimulus, right? Because it's first into the market. You've got economists saying we've got to pay all this money back. It may be difficult, but you've got investors on Wall Street saying give us more stimulus, give it to us, give it back. Last week in the market. So when this package does finally come, do you think that it's going to sort of be a sell the news kind of thing?
Well, look, I still think you're waiting to see the $600 economic impact payments, the most recent amount of stimulus, work its way through. The initial checks that were sent out in the spring of last year had a much greater economic impact than I think most people, most economists, most Wall Street strategists thought that they were going to have. And so this next round, when you combine the $600 payments and hopefully the additional $1,400, when that makes its way into the economy, in my estimate, that's about $1 trillion of cash directly into the economy. I think that's going to have a huge impact. I don't know that we're necessarily going to get a sell on the news, but I think that's going to be a very, very positive flow through to the underlying economy versus, you know, the hundreds of billions of dollars going to state and local aid and COVID relief and school reopening. I think these direct checks are going to have a huge impact, and we won't really know the full extent of it until sometime in the fourth quarter or even the first quarter of next year.
Okay, so you're saying that it's got long-term legs. It'll play out in the economy and the bottom line. And Gregory, we know that the Fed's going to be watching closely to see how the fundamentals are doing in this economy. And it sounds like they should improve, especially as we get out of the pandemic and things start to recover in a real way. But we're also watching interest rates, which is some of the reason that we've seen the stock market move a little bit higher. Do you see a Fed, reacting to fundamentals that are stronger in any way and saying, okay, it's time, it's been long enough, let's start to slowly raise rates?
Sure. Jackie, thanks for having me. It's a fantastic question. It's on the minds of many investors. So we've got a tale of really two different yield curves right now. On the very short end of the yield curve, we've seen a lot of pressure on rates. There's this ton of cash in the system, both through fiscal and monetary, that's looking for a home to invest. And we basically have a supply imbalance in terms of assets to invest in. So on the short end of the curve, rates have actually been moving lower, and if anything, challenging that zero lower bound. On the long end, and as we wrote to clients this week, long end rates typically behave very well when the Fed is fighting inflation. We had the chairman of the Federal Reserve last week say, show me the inflation. So the Fed wants to see inflation. Watching the show earlier, John Hilsenrath, I think laid it out really nicely in terms of prices, consumer prices, asset inflation. We have seen asset inflation. We've seen a lot of this cash flow into assets, but the reality is I think the Fed wants to see wage inflation, right? So that flows to the job market. If you listen to Powell last week, they're very focused on this broad-based, inclusive, looking at shortfalls in the employment market. So I think the Fed is a long way here from changing their stance. Earlier this year, we did have some talk about bond tapering, which I think has been put on the table, but certainly, full disclosed, if the economy does improve the way we expect it to improve in the second half of the year, certainly the dialogue will change with regard to asset purchases.
Michael Hewson, I want to get your take on the markets because they're closed here in the United States, but the European markets are trading today. And Europe, of course, facing more lockdowns, restrictions because of the pandemic and, new variants coming out as well. And a recent analysis from Cornerstone Macro warning of a potential for a double dip in the Eurozone as vaccine rollout remains slow. Your thoughts on that and how it would impact what we're seeing here in the United States?
Well, I certainly think that the narrative of a double dip in Europe is probably already in the price. There's already talk of further easing of monetary policy from the European Central Bank, though I'm not quite sure how they can drive rates that much lower than they already are. They're already negative to the tune of 0.5%. And this morning, industrial production here in Europe for December posted a 1.6% decline. Now, later this week, we have the latest flash PMIs from France, Germany and the UK, and particularly services have been very weak, given that lockdowns here are still in place and likely to remain in place for at least the rest of the first quarter. However, there is optimism about the vaccine rollout program, more so here in the UK, where around about 20% of the UK population have had their first shot. The Europeans are slightly further behind at around about 4%, and I think that really is the concern going forward. You're seeing the FTSE 100 up by 1.5% in early trade this morning, and I think that's largely on the back of optimism that we could see restrictions eased here in the United Kingdom by the middle of March. I think Europe remains that much more cloudy because of the lack of vaccine rollout progress.
And that certainly would be positive if those restrictions were lifted and people could be out a little bit more, spending more. Michael Lee, Greg Faranello, Michael Hewson, thank you, gentlemen, for your time this morning.
Thank you.